So, team, hot off the press, the latest CPI print is out. Headline data is exactly as we expected. For the first time, the analysts got it right. We've gone down from 7.9 to 6.8% on the face of it, a large drop. However, I've spent the last hour going through the actual report, seeing what's going on below those headline numbers. And there's two things I want to focus on today. Well, one main thing, and that is what has actually happened to the core inflation. That's the thing that really we care about, not the headline rate, but the core inflation. But secondly, what else are we seeing in the trends in that data to try and forward project what's going to happen over the next 12 months, and how is that going to affect the UK property market in the short, medium and long term? So that's what we're going to go on today and talk about. So first of all, good morning to everybody. I know it's a little bit earlier than normal. I got a full day, so I wanted to get this out live straight away so we don't lose any time. Give me a thumbs up if you can see me, you can hear me, and the audio is working correctly. As we go through this, please put your questions. As always, I will get them answered for you. If you're watching this on the replay, please put your questions or points in the comments, and I'll always get back to you. And if you are new to the channel, please give me a like and a subscribe. On these live shows, what we do is look at current data, current affairs, current news, get through the headlines, work out what's actually going on beneath the hood when we get rid of all the hyperbole, okay, and how that affects the UK property market, specifically for investors. So we want to have that crystal ball so we can make better investment decisions. Good morning, everybody. Graskew, is there any need for the long introduction? Yeah, just to explain the long introduction, it's just so the live algorithm gets out and people can get onto the live stream, gives a little time for that live stream to warm up and people to get on. Let's dive right into it. And I apologize for the need to put my glasses on this morning because there's quite a lot of small print. So here's the report. I'm going to go through it so you don't have to. As I said, the main headline on this report is that inflation is down from 7.9 to 6.8. And the main driver of it is the drop-off in energy prices over the last 12 months. So when we look at the individual figures, you'll see a huge drop-off in those sort of electricity, gas prices. If you rewind 12 months ago, it's when we're really going into sort of the spike of those energy prices. So because CPI is a 12-month rolling metric, it's comparing where we were 12 months ago to where we were now. Big drop-off on that. However, we also have some increases in here. Hotel and passenger transport by air were the classes that provided the largest offset upwards. And actually, this is going to be a really key thing for us to look at in trends, the cost of transport. Okay, so let's have a look at the graphs. Here is the main graph. And the thing I want to highlight to you, right, is this dark blue line at the bottom. So the light blue, medium blue are CPI, CPIH. CPIH is when you include housing costs. So there is a slight difference here. That dark blue line at the bottom, which is still going up, okay, that is owner-occupier housing costs. So the first thing we can draw from this data is even though the headline rate of inflation is coming down, there are elements that are still going up. Now, this is going to be a concern for, number one, owner-occupiers, also for renters, but also for the Bank of England, because this is going to start to impact on the core as well, although OOH, owner-occupier housing costs, and core inflation are two different things. There is a link between them. So we can see OOH is continuing to go up. Okay, I'm going to skip past that graph, and I want to go into the individual movements in prices. So if we look at these prices, I want to focus on this right-hand column, the July 2023 column here, okay? And we can see clothing, and we've got some big drops here. We've got clothing and footwear minus 2.1% month on month, housing and household services minus 1.4%. Now that includes electricity and gas prices. So that makes quite a large percentage of this calculation. There's various weightings for all of these. Furniture and household goods minus 1.3%, communication minus 2.5%. Now, we can see that a lot of this stuff are goods. Goods are coming down, and we'll see the overall trend for goods in a little bit. But there's something I want to highlight here, because this is, I've not seen in any of the headlines that have come out this morning so far, this particular metric. If we look at transport, I've tried to put it, let me go here in the middle, right? It's this 1.3 here. 1.3% month on month, transport has gone up. Now, if we remember last month's figures, when the CPI headline figure dropped, the main reason, the main driver for that was transport dropping. And if I just flick to last month's report, okay, and we go and zoom in to that transport again, right, that's the one in the middle, month on month, last month, minus 0.7%, which was cited as the main driver in the last print for inflation coming down. So for me, this is a fairly significant thing. We've gone from minus 0.7 to plus 1.3. And if you saw last month's live stream on the CPI, I said, yes, CPI is coming down, but the thing we care about is core inflation, because the main CPI includes volatile commodities like gas, electricity, food, and alcohol. Okay. Now, transport is actually included in the core. And I said, actually, oil, petrol, diesel, right, are actually quite volatile commodities as well. And when we forward project, we can the predictions for Brent were to rise over the next 6 to 12 months. And so if the prices of transport started going up again, which could happen organically, but could also happen from third-party shock, so supply chain shock or escalations in war or other supply changes, that could start feeding back into the figures again. So even though transport on a 12-month rolling basis has come down, and they make quite a big deal of this in the report, month on month, it's ticked back up quite a long time, quite a lot. Okay, so I think that's interesting. If we look at the price of Brent crude, by the way, over the last month, it's up. It's up sort of 7%. It was up 10% last week. But those predictions of Brent crude going up, prices going up, right, are feeding in already. Now, what is the effect of this? Right now, in the main CPI figure, nothing. But as we go into the future, go into next year, those are going to start feeding back in. So for me, that's something we need to watch, is what's happening with those transport costs, those fuel prices, because this could start to embed into that sort of sticky inflation and the core inflation as we go into 2024. I think that's pretty pertinent. I want to watch that as a trend. One uptick over a month is clearly not a trend. However, if we see it stick there, right, this time next year, we're going to see that sticky inflation. Okay, perfect. So that's transport. That's the first thing to highlight in this set of data. The other thing that has gone up, so this 0.9 here, right, is restaurants and hotels. Not a essential restaurants and hotels, but still going up quite a lot. And I suspect that even though our gas and electricity prices are coming down, in terms of what we're actually paying for these, for residential, we've still got the energy. We have the price cap in place, energy price guarantees, which I know the price cap is now below the government energy price guarantee on the latest price cap. For businesses, this is slightly different. Okay, a lot of businesses, mine included, and I know this from a very painful process that we're in at the moment, a lot of businesses have been fixed for 1 to 3 years on rates that are still extremely high from last year. So right now, my scaffold business, I'm fixed on 77p a kilowatt hour until November. Mental, right? Which meant that my prices went from 16p a kilowatt hour to 77p a kilowatt hour. Government was subsidising that. They stopped that in businesses at the end of March. I'd imagine there's a huge amount of businesses, especially hospitality, who have very high energy costs, and that's really crippling their businesses, which means those prices have to come up. So that's going to be interesting to see what happens from there. Okay, let's scroll down further in the report. Food is starting to come down. It's still at 15%. Everybody's celebrating food coming down, but it's still at 15%. And again, I think something that's going to be very interesting to watch over the next 12 months is what happens with food, because it is right now susceptible to, again, third-party shocks. It's susceptible to crop yields, and we've seen some pretty random weather. Okay, you look at China, look at Europe, look at the States, and pretty random weather that I feel is going to feed in to food prices over the next 12 months. Let's just have a look at this particular article. Orange juice prices to surge as US crops ravaged by disease and climate. This is a couple of days ago. Orange price concentrate. Is it a film? Was it the Eddie Murphy film? Trading Places. I think they're literally trading orange juice concentrate, right? It's gone up 300% in the last month. I think it is something ridiculous like that. It's trebled in price, orange juice concentrate in the last month because of poor crop yields in the US. And I think we're going to start to see that filtering through from this I believe like weather temperatures have been broken in China, they've been broken in Europe, and that's probably going to have an issue or a feed in as well. Okay, so food prices coming down, but still very high, 15%. Transport, this is a great one, right? When you look at this graph for transport, okay, this is the year on year. We've got a drop year on year still. This black line is, let's just see that, is motor fuels, right? The big one, motor fuels, year on year, still coming down considerably. But as I said, if you actually look at that month on month, they've gone up considerably month on month. So you've got the headlines talking about the continued drop in motor fuels, but the reality is there's an uptick. Does it turn into a trend? We'll see. Let me know what your thoughts are on that, team, by the way, in terms of selective reporting or selective headlining of data. Because if we read this, right, what's it say? Transport. There you go. Transport was the only division that saw a negative annual rate, is the first point in that transport. The only division that saw a negative annual rate. Statistically true. However, it is also, when you look at a month on month, the highest rising month on month aspect in the entire report. So that's transport. Let me know what you think on that one. And here we go. Here's what I want to sort of show. Now, I want to get rid of some of these. If we look at CPIH, so again, just to confirm, team, CPIH is CPI, but with householder costs as well. So it includes that OOH, owner-occupier housing costs. The ONS say itself that the CPIH is the most accurate CPI, even though all the headlines are CPI, so it strips out that householder cost. I don't quite understand why they would do that. When you put them back in, this is the most accurate CPIH. However, if we go to goods, right, we see that goods are coming down rapidly right now. So that's down at what, sort of 5.5%, 6%. But look at services. Okay, services are still accelerating away up in terms of price. Now, why is this relevant? Why do we care about services? I'm just going to come off the screen for a minute. When we look at wage growth, and we're going to look at wage growth in a minute, because I want to relate this in a second to interest rates and what's going to happen to interest rates. The majority of wage growth, the majority of what we do in the UK is service-based. We're a service-based country. So our manufacturing, is sort of dropping off, has been for, decades and decades, and we're primarily service-based. When you look at the wage growth data, the main contributor to the wage growth at the moment is the service-based sector. So I actually looked at the individual figures this morning. I think service-based sector is above 9% wage growth. So overall wage growth, it's just hit the record highs, 8 point something. But I think public sector is sort of 6, manufacturing in the middle, service-based at the top, right? So it looks, when we look at this data, that we've got potentially that sort of price wage spiral going on in the services sector. And because we're so heavily service-based as a country, that's going to carry on that sort of wage price spiral in that sector, which must be a head scratcher for the Bank of England when we're looking at interest rates over the next, the next 12 months. If this continues going, which, the trends are up, they're going to have no choice but to continue to ramp interest rates. So if you remember last month when the inflation data came unexpectedly down, those projections for interest rates went from, I think, peaking 6.25 to 5.75. Already this morning, I've seen analysts come out and go, actually, we're going to have to go higher again. So we're back up to 6% as a predictor. And we're going to have to keep an eye on where this is going. Okay, so there we go. There is our services. If we look at the whole CPIH, now this is CPIH excluding energy, food, and tobacco. So this effectively is now the metric we really care about. This is core inflation. Okay, this is a thing that is internal to the UK. It's kind of hopefully stripped out all of those volatile things. And if we zoom in, okay, this is hardly a rapidly dropping graph. This is the graph, this is the line that rate setters will really care about, okay? So you can see we peaked 3 months ago. I think it was May. So May it peaked, June came down a little bit, and now we're flat again, right? So there's been no drop in core CPIH this month. That will be an extreme worry. Everybody was hoping to see that core inflation come down, because when the core inflation comes down, it's like, okay, we've got this domestically under control now. Because we haven't, I'll let you express your thoughts on how you think that's going to affect the interest rate. Okay, let's go down to there's one more graph I want to talk about here. This is, again, this is relevant for the sort of property sector when you're looking at what's going to go on with property prices, interest rates. This graph are the individual components. Sorry, let me just go up a little bit because I think it's slightly off the screen there. The individual components of the housing and household services element of CPIH, right? So you can see at the bottom what that actually includes. You've got electricity, gas, other fuels. You've got things like your maintenance and repair. You've got your water and sewerage, council tax, rents, and OOH, owner occupies housing costs. So if we just strip everything out of this, other than the electricity, gas, and other fuels. We can see how that has come down so rapidly, if I just zoom in there, so rapidly in the last month. So we had a huge drop 4 months ago from that spike, you know, sort of end of last year, beginning of this year. Then it's kind of sat there for a few months, and this is because the energy price cap goes quarterly, right? So we've just dropped, when you're comparing it 12 months on 12 months, we've now had that big drop out this month. So you can see huge drop down. If I just go even further into that, huge drop down. The problem is it's not got a lot further to drop now, because energy prices are not going to come down much more, or predicted, you know, the analysts saying not going to come much more now, for however long. But we're now going to go into autumn, into winter. Energy price cap is forecast to go up a little bit in the last quarter of this year. And there are some worries about cost of gas spiking again. Remember, these are volatile things. So there's not a lot further to drop here. It could go back up. However, if we strip that out and look at rents, look at that. Okay, this is rents continue to gain pace in terms of rent increases. We've got a big spike in rents this month. And again, if we go into owner-occupiers housing costs, we see that steady rise in the OOH. So rents, occupier housing costs. Now, I don't want to go in too much as to how owner-occupier housing costs are calculated, but they actually, in this data, they use something called a rental equivalence, which is if somebody was owning their own house, they equate it as if they were renting it to try and work that. It's a slightly complicated and bizarre methodology. There's several methodologies to work out this. But funny old thing, interest rates still going up, rents going up. All of this is putting upward pressure on people's actual sort of affordability. And what I think is quite interesting is when you look at the skews on these, or the weightings on these, right? The weightings on these were calculated quite a long time ago. I say quite a long time ago. I think sort of early 2010s, the weighting. And when you look at what's happening, I would suggest that the weighting has changed. So in terms of everybody's affordability on a month-by-month basis, this has more impact now than it would have done 10 years ago because of people's debt or rent as a percentage of their incomes, if that makes sense. Okay, so we can still see these costs are going up. Or these, so the average person on a day-to-day basis is probably going to be hitting their pocket still with these costs going up. So put it all back in, put that and rents in, okay, still going up quite considerably. So those are the main things that I want to talk about in CPI. We're still lagging behind everybody else. If I just compare us to, there we go, let's just take all of that. We're the blue line at the top. France is the light blue line. America is the green line. We're still lagging behind. There we go. We are lagging behind EU and Germany as well, but not quite as much. And I think that's the main things I want to cover in the CPI report. So again, if I just take out all of that, just to reinforce, let's recap what this has shown us. Headline CPI is down. Core CPI is unchanged. Owner-occupier housing costs have gone up. One little aberration in the data we've seen is the cost of transport, which includes motor fuels, has gone up by the highest, by over 1% month on month, even though the 12-month rolling is down, the month on month is up. So that's something we need to watch. Let's couple this with the data that came out yesterday of wage growth versus price rises. So this was yesterday. Okay, wage growth, average weekly earnings, excluding bonuses, hit an annual growth rate of 7.8% during the 3 months to June. So that's the highest it's been. And this graph here, I think this is from Sky, showed it hitting inflation yesterday. Now with inflation CPI down, the wage growth is going to surpass. So people are getting richer every day. So we have core inflation sticky. We have wage growth now accelerating and outstripping inflation. This is definitely 100% going to be causing head-scratching moments for the Bank of England when they look to do additional rate rises. I would bet on at least 2 more rate rises. Predictions are now saying 6% after 5.75 over the last week. Let's see what the swap market does over the next couple of days. Let's see how the mortgage lenders start to affect things. Of course, this is all going to feed in a very sort of laggy way into the property market. The only other thing I wanted to talk about today on this was unexpected uptick in unemployment as well. Okay, so record pay growth, but unemployment went from 4 to 4.2%, which was unexpected. Nobody was expecting that. Vacancies are dropping. So vacancies that are being advertised are continuing to drop. So we definitely have a cooling jobs market. No growth in the economy. So we've got an interesting cocktail of factors right now when we look at what's going on with the property market. Okay, team, let's have a look at what questions. So that's the overview of where we are today. Let me know your thoughts on what trajectory that's going to have. Shane, how you doing? Is this winter peak fear, or is the China domino about to fall? Yeah, it's a good question. Good question. I don't know. I'm just gonna. I didn't show actually. Let me just show you this. You talk about sort of winter peak fear. I did want to show you this actually. So we do have uncertainty in gas price again, talking about sort of gas going back up over the winter. There are, at the moment, price surges going in because of third-party shock factors. Okay, so we've still got this really interesting mix. I think we're very fragile right now. The economy is flatlining. Okay, interest rates continue to go up with this lag in the system. Unemployment is now starting to uptick. Caveat, it's still historically low, but it's the trend. That's another month trend of it going up. So we're seeing a trend of it coming up, and core inflation is being sticky. So cocktail of factors. I would love to know your thoughts. Any questions from the team this morning before I get on with my busy day, which is why I came live this morning. I wanted to get this out hot off the press before I go and do morning exercise and all of that sort of good stuff. Let me know. Any questions, team? What's the predictions for the next interest rate rise? 0.25%, or they're going to go 0.5%? We'll see. Right, if there's no questions, I will call it a day there. As always, if you find any other questions you want to have, go to the replay of this on the channel and hit me up with questions. And I look forward to seeing you next week on the next live show. Have a great end to the week, everybody.